Good morning and welcome to the Augmentum FinTech PLC annual results investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time via the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Tim Levine. Good morning to you, sir.
Good morning, and thank you, and good morning to everyone who has dialed in. Just to give you a sense of what's to come over the next few minutes, I plan to just take you through a summary of our annual results, all of which is available on our website as well. There's quite a lot of detail in here. The plan is not to go through each slide in detail, but to give you a bit of a snapshot of what's been happening over the past year, and also a little bit of the look forward as well, the direction of travel, the sense of what we're seeing in the market. We also have a good amount of time to answer questions as well, which I'm very happy to do so. The challenge, of course, will be to get through all the questions in time, but we'll do my very best. There have been a number of pre-submitted questions as well, which I've had a chance to look at as well, and we'll do my very best to get through all of those. And you're able to kind of post those questions in parallel with the presentation as well. I think for me, this is always a great opportunity to get in front of our retail investors. I think by looking at some of the questions that we've already had and historically, it's a great opportunity to address some of those issues, opportunities, concerns, and in some cases misperceptions. And so this is something which I really enjoy doing, and look forward to the conversation over the next hour. So without further ado, let me kick off and just take you through where we are. And just to remind those shareholders on the call and those that are looking at Augmentum for the first time or have been following it for some time, what are we trying to do? Our job is to provide diversified exposure to high growth, early stage fintech assets, predominantly across the European fintech ecosystem. We talk about giving access to the inaccessible, and that's very much something that we hope we have been doing and will continue to do over the coming years. Our job is to filter through the huge amount of opportunity and noise in the market. We track some 6,000 plus companies and 14,000 individuals across Europe and beyond who are involved heavily on a day-to-day basis in the fintech ecosystem, and try and really find that needle in a haystack. At the same time, we are in the business of taking risk. We're backing big visions, big opportunities, and we're looking for those companies that ultimately can deliver that outlier opportunity. And so we are looking to build that portfolio where inevitably, even in those phenomenal success stories, they are full of ups and downs. And as we often explain to our investors, it is not an overnight success story. These are businesses that take a lot of time, help, and effort, and often capital in order to be able to deliver those positive outcomes. And hopefully over the next half an hour or so, during kind of taking you through this presentation, I'll be able to kind of shine a light on the journey that we've been on. And here's where we are today. Now, just to remind everyone, this is for the year end March. We are already at the beginning of July. Interestingly, when the year end happened and when the valuations happened as well, and many of you will be aware that these are independently audited by our auditor BDO, who will kind of scrutinize both our valuations alongside our valuations committee, which is managed by our board, and remember the board as well are all independent. So we as the manager do not sit on the board. We have 5 independent NEDs on our board that oversee the valuations as well. So I think really important for that independent scrutiny as well. At the time in which this happened, we were in the height of tariff gate, and so we did see a pretty significant multiple compression in the market. we've seen some kind of rebounding, and we'll talk a little bit about that as well in the market in those multiples. But I think important to shine a light on the point at which that the line was drawn at the year end. So we are, now just under 300 million. As you can see, a significant discount to the NAV, and we'll talk about that as well. Cash reserves are always important for us to make sure that we can lean in to those portfolio companies to continue to support their growth, but also support the next generation of high quality, high potential fintech companies as well. And still good underlying growth in the core assets in the portfolio. We talk about top assets. Why do we talk about that? Yes, there are 25 odd assets in the portfolio, but the top 9 represent about 80% of the NAV. And so we take kind of the 80-20 approach in that analysis. It doesn't mean that there are some very exciting high potential assets in the residual 15 or 16, but at the same time, important that we kind of focus on that core of the NAV as well. And of course, the true test of a portfolio is, are you delivering exits? Over the previous 7 years, 100 million of exits, they on average have been north of 30% above the holding value, which again is important to reinforce that net asset value. And of course, delivering that IRR, which is north of 30%. For us, the target is to be delivering that 20% IRR over the long term. And that is something we're very much looking closely at and feel that we're on track, but there's still a lot of work to be done. So what do you have in this portfolio? And, as I said a little bit earlier, it's really important that we give investors that diversification across the full spectrum of fintech. So what you have here isn't just a collection of companies, but what we think is a collection of incredibly interesting assets across the European ecosystem in particular, in a number of subsectors where we feel there's significant potential. You will see this chart ebb and flow over the months, just in terms of the relative NAV, in terms of exits and entries into the portfolio. But we feel this gives you really balanced exposure across a number of those areas where we believe there'll be considerable disruption. And of course, the weighting at the current time, in particular, you will see in the digital banking and lending and on the SME and consumer side, as we see some real breakthroughs with some of our companies in the portfolio that are really kind of becoming significantly established in scale and increasingly in profitability as well. I won't dwell too much on this, but again, for something for you to kind of look at in more detail on the evolution of the portfolio and how that has evolved over time. But what's been happening under the hood? And rightly, investors will look at those top 9, which represent 80% of the NAV, and they'll be looking at that kind of third column in each of the company slides, the green or the red, what's gone up, what's gone down. You'll see kind of a number of bits of green there, and that often is kind of either strong underlying performance of those particular portfolio companies, or there's been an independent valuation round as well. I think where you see kind of smaller drops or smaller increases, that often is in terms of the valuation approach and the methodology, and they are often used if we look at kind of how the auditors and valuation committees are approaching it. It is using a basket of comparables, in particular public market comparables as well. And in some cases, you might see a company performing very well in underlying. I'll kind of point to Zopa as a good example of a business that has been trading strongly, really good top line growth, becoming increasingly profitable, and very much seeing that kind of gross margin improve over time as well. But dependent on the basket of multiples that you're using, you might well see some kind of contraction in the multiple there, which brings a small discount. I think the big frustration that we've had over the past 12 months has been the write down in our German based business Grover, a consumer electronics platform. Ultimately, it's an alternative to buy now, pay later, or buying outright. It's electronics rental. That's its kind of core proposition, and that's gone through a very significant restructuring over the past 12 to 18 months. I think the nature of venture is such that, as I said earlier on, you have to take the rough with the smooth. We are engaged in our businesses typically. We take a board seat when things don't go well. It's not about holding up your hands and saying nothing we can do. Where we can, we really do engage. And our COO and co-founder, Richard Matthews, has moved on to the board in the past 12 months and become chair and really helped oversee a turnaround of that business. We feel the business is in a far stronger position today. It has right-sized its debt position. It has recalibrated management. There's been a significant amount of change in there. But at the same time, as much as we think the business still has significant future value potential, we need to value the portfolio as it looks today, not on what we hope it will look like. And as such, there has been a very painful recalibration and re-rating of the valuation there, which has really kind of countered a lot of the positive growth elsewhere in the portfolio. Something that we do and we don't ignore, but you won't necessarily see us responding, is we do look in particular in a number of those kind of well-known retail platforms that often have message boards as well, and we kind of can read and see a lot of the chatter around what's going on. Some of it is well-founded, others is less helpful. This is why today is such a good opportunity to really kind of help give investors a accurate representation of what's going on in the portfolio. What we're not doing is hiding bad news. Absolutely not. Ultimately, the valuation process is all about looking at that moment in time and reflecting objectively and independently what is the third-party value, what would somebody likely pay for each asset in the portfolio if you were to sell it individually. It's always hard with private assets, but we feel that we've always taken a prudent and conservative approach to valuations. And when you look at the exit track record of the business, selling on average at 30% above the holding value, I hope give investors comfort that that's actually the case. And that's not just the higher profile, more established assets, even assets that haven't ended up being venture outcomes, and that is the nature of the beast, where we're going to have assets sitting in the portfolio. Where we find the opportunity to exit them, more often than not, we've managed to deliver exit at or above the holding valuation. So here is a compressed summary of what you've seen over the last 12 months. So yes, there's been significant growth across the portfolio, and you can see that in that green chunk. But also, that big revaluation of Grover has countered a lot of that growth impact, alongside that moment in time in which we did the valuations year end. That multiple compression in the market has led to a countering of that growth impact as well. But the message that we do want to get across is that there are a lot of businesses within the portfolio that have made great progress. And I think when we look at where we've come a little bit later on in terms of that path to profitability, you'll see kind of that shift. But at the same time, it's important that we continue to support both the existing portfolio and also capitalize on what we think are some exceptionally exciting opportunities. As I said at the beginning, our job is to try and find those outliers in the market, find exceptionally talented management teams with bold visions, trying to build really significant businesses. And we believe we found two exceptional founding teams in both Loop FX, which is building an institutional dark pool for spot FX, and also Pemo, which is an unusual business, not in terms of what it's doing, but in terms of the geography where we haven't historically focused. So corporate card expense management, a big market in Europe and in the US, and very significant kind of unicorn, decacorn businesses. At the point in which that market was heating up, 2020, 21, we saw a lot of overheated, overpriced rounds in Europe. And we felt that despite the fact that we had conviction in the underlying strategy and the sector as an opportunity, we didn't feel that the opportunities that were being presented to us represented great value for our investors. So we sat on the sidelines, but we have continued to track that space. And the best known and most valuable corporate card expense management business for enterprises in Europe, Pleo, was one that we watched closely. We saw some talent that came out of that team. moved into the UAE and looked to build this platform out for the Gulf. And that's what PEMO are doing. And they have only launched in the UAE, but Saudi as well. And we back that team in order to build what we think could be a really valuable business in time. And that really is a great encapsulation of, one, the reach that we have in the market, two, the approach that we have to tracking and visibility and talent, that if we are seeing talented senior people leave high regarded organizations to do something else, it could be something similar or it could be something in a tangential area within fintech. It's our job to go in and talk to them and say, is this a team that we might want to back? Not necessarily now, but in the future. And I think PEMO is a great example of that. So how are we tracking? And often the frustration of what we're building is investors often look at the share price. And rightly so, because ultimately we could be making great progress in NAV, but ultimately if that's not reflected in share price, then we recognize that there's significant frustration. But venture and backing at the Series A isn't something where you see delivery overnight. We've been going 6-7 years. The portfolio is really starting to develop. But I would say after 10 years, you're starting to see some very defined and clear benchmarks to see, is this a fund? Is this a team that is delivering? And I think when we look at our two vintages, which if we were a traditional venture fund, something known as GPLP structure, we'd be looking at 3-4 year investment periods. And you can see that first 3-year investment period where we back 19 portfolio companies. How is it tracking? How can we compare with our more traditional peers where 99% of venture funds are in these more traditional GPLP structures? And you can see that we're tracking in the right direction. If you look at DPI, which is distributions paid in effect, what are the realizations coming out of that portfolio? We're tracking in terms of top decile in that measure, and that is a really important measure. Yes, people can look at valuations at top line, but ultimately the true measure of success of a venture capital manager is in realizations and returns. We believe that there is a lot of momentum behind some of our core assets. We believe the returns will start to deliver in real substance in the next 2 to 3 years. And that will be the moment in time to, I think, measure the effectiveness and success of the manager. We're on the right track. We think there's a lot of momentum behind us, but fundamentally, the true test of this team will come in 2 to 3 years. But as I said, on this really important measure, we are tracking in that top decile, and that's important. Early days for the 21 and beyond vintage. We're well ahead of the benchmarks at the moment, but let's see where we are in 3 or 4 years. But as I said, the measures that we think are important really pointing us in absolutely the right direction. So what's going on in the portfolio? Well, this is what you would expect to see in terms of, one, we want to have the weight of the NAV towards the later stage. We want to have visibility on exits that can recycle back into the portfolio. You would expect, on average, these businesses still to be growing. You could see that, and it should come as no surprise that the earlier stage businesses are growing much quicker. But let's not underestimate that growth rate of those late stage established companies. We would like to see them growing north of 20%, on average growing just over 30%. That's really encouraging. In parallel with that, we want to start to see that those unit economics really drive forward as well. We want to see that path to profitability, or as businesses start to look at profitability as an important measure, again, that's important that we see that progression. And here is where I think you will have seen the dramatic difference in the profile of the portfolio, where we're in a very different world than we were in 2022, where there was cheap money, interest rates were at zero, and the focus was all at growth at any cost. Just put your foot down. You can raise as much money as you possibly can and keep growing. Don't worry about the bottom line. We want you to go out there and win the segment hard, and it's all about capital. There has been a seismic shift in attitude. we always took the view that positive unit economics are important, that we wanted to back businesses that had strong fundamentals. It doesn't mean that we didn't want them to continue to invest in growth. We're not managing this portfolio to maximize profitability. We're managing the portfolio to really try and back big visionaries, trying to build category winners that can ultimately deliver outsized exits. But of course, there comes a moment in the portfolio where you have some of those maturing assets where the market is looking at, okay, if these businesses are going to exit, we do want to start to see the profitability come through. And you can see that real dramatic shift since 22, when there was a shift in approach where the market was saying, we want to see top line growth, but we also want to see improvement in gross margin. And we'd rather see 40, 50% growth and profitable businesses and 100% growth and unprofitable businesses, or very unprofitable businesses. And you can see how hard many of our portfolio companies have worked and been effective in shifting that, how hard we've worked with them to deliver that message. And I think this is a chart that will continue to show as the portfolio profile continues to kind of have those core assets that are moving towards those kind of established, I wouldn't say exit door, but when exits become more of a viable opportunity over the next 2 to 3 years. And we'll talk a little bit about what we're seeing in the IPO and exit market as well. But this is a chart you've all seen before. And I think the question that I was asked more so than anything else was the opportunity of what is the runway of these businesses? When you didn't have any profitable businesses, do you have enough cash on the balance sheet? Do these companies have enough cash on the balance sheet in order to get to profitability? And you can see that real shift where you've got businesses, four of the top 9 or 10 profitable, one in tide, breaking even, but also there are other businesses that still have kind of strong growth ambitions, or in Grover's case, where we've had a significant restructuring, we need to ensure that these businesses either can get to break even with the current cash on their balance sheet, or in a position that if they weren't able to raise more money, they can pull back that growth ambitions and shift to break even quite quickly. So from our point of view, we're really happy with where the portfolio has gone to. This is not a heavily cash consumptive portfolio. Of course, we want to be able to lean in where we have conviction to continue to support the businesses, or when we feel they need a little bit more time in order to get there. But fundamentally, this is a real sea change from where we were 2 or 3 years ago. But the elephant in the room, which I'm absolutely taking head on, is how can we navigate the persistent discount that we've seen. When you look at the implied portfolio value after cash, 136 million, you can see that when you break down the asset base, and even if you just look at the top 9, your top 5 are valued more than the implied portfolio value. So the market is ascribing zero value to the residual 20, which we would argue violently that it's absolutely wrong. We recognise that there are structural challenges at the moment in the London market. We're not alone suffering from this discount, but sitting and hoping and waiting for the market to turn isn't really the strategy that we've been employing. Yesterday, we had our institutional capital markets day. We had 120 institutional investors in the room. We had a number of our portfolio CEOs and founders present the story. There were a number of shareholders, but also a number of prospective investors who are following the story, like the idea of getting exposure, but want to really hear and better understand what's going on within, under the hood in the assets. And we're doing as much as we can to kind of better tell that story as well. And I might just jump back to that, just to give you a sense of, we are not ignoring what is happening in the market. We are working harder than ever. We'd argue pedaling twice as fast to make sure that, one, we recognise that we need to expand the investor base. Unfortunately, wealth managers are consolidating. Their minimum size of investment trusts has continued to grow. So the marginal buyer or the new buyer is becoming harder to find. It's it's something that we've seen that's been kind of reflected, I would say, elsewhere in the market. We're not alone. But again, it's about being out there doing more. It's about making sure that we punch above our weight, whether that's in media, whether that's not just in traditional media, but social media as well. And just being regarded as a voice of fintech, being thoughtful in our approach, and making sure that we're kind of helping drive the agenda. And we spend a huge amount of time on that. And ultimately the ambition is, one, to further the fintech industry here in the UK and beyond in Europe as well. But two, to make sure that we're shouting about the huge potential ahead that we're seeing in the market. And that's incredibly important. The results don't happen overnight. We recognize that. But we are a small team, but we really do put a lot of thought and effort into making sure that Augmentum is as high profile as it can be, for all the right reasons. We don't want to shout for the sake of shouting. We don't want to kind of go to every possible event. We're really thoughtful in where we speak, what we speak about, and what we're involved with. But ultimately, it is all about furthering the industry, but also furthering the brand of Augmentum to try and bring in more shareholders to ultimately help us drive the price upwards, and for them to believe in what we're trying to build in the long term. But let's talk about valuation. Let's talk about multiples, what's going on in the market. You can see here that we're kind of reverting in the public markets back to kind of that more recent norm. If we took this, which unfortunately the valuations often were based on in March 24, that was actually closer to 4.5. And you can see that kind of significant rebound that we've seen since March to June as well. But what we have shown in our portfolio, improving profit margins, increasing focus on bottom line growth as well as top line growth, you're seeing that same trend persist in the public markets as well. And that has been a real focus for both public and private companies. And this is something we've been showing investors for many years, and I think is incredibly important. And we recognize that there is a lot of scrutiny on valuations. And we always talk about when the market really lost its head in 21, they were, frankly, the forward revenue multiples of the listed fintech index, were trading at unprecedented multiples. In terms of this chart, you can see north of 12. The Augmentum, yes, the Augmentum multiples did grow, but nowhere near the extent of where the listed market. And where you look at us now, you can see that big spike up in June in the high growth listed fintech index. And when you apply the discount to where our multiples are, our average revenue multiple of 4.1, we're trading at about a third of where the listed multiples are, with businesses that are growing on average at around the same, or in many cases much faster than a lot of these companies. So again, this is a really important message for us to get out to the market, that we've got a lot of high quality companies. They're growing incredibly well at the top line and the bottom line. And at the same time, we do not believe that the discount is really justified. And our approach to valuations historically has been appropriate and conservative, and one in which we think deserves a re-rating in the market. It's important that we continue to deliver that. And, again, when we look at some high-profile listed fintechs, and we look at some high-profile private fintechs, and we look at the direction of travel, how are they growing, what's their next 12 months multiple, you can see the growth is 20 to 30% on average, 8 to 9 next 12 months revenue multiple. Again, how are the top assets growing at Augmentum? What is our market adjusted? A fraction, a quarter of what we're seeing in terms of elsewhere in the market. So again, when we get under the hood, it is about us demonstrating that the market is improving from a multiple point of view. We've seen 3 high-profile listed fintechs go in the US, and Chime, eToro, and Circle. They've all kind of gone in the last 2 months and gone really well. I mean, Circle has gone extraordinarily well, 600%, arguably very much in frothy bubble territory. But even the likes of Chime, where we've got some really good read acrosses to the likes of Zopa or Tide or iWalker, our businesses stack up incredibly well relative to Chime as well. So we want more high-profile fintech IPOs. We want them to go well. We want them to be successful so we can have those positive read across and give data to the market, to the analysts, to the investor community that, the portfolio represents great value and there's some high quality assets that at the right moment will present phenomenal exit opportunities for us as well. And, as I talked a little bit earlier, the exits remain the true test of this portfolio, which will come over time. Touching 100 million is a great milestone. We need to do a lot more. But what we're not intending on doing is exiting for the sake of proving to the market that our businesses are appropriately valued. That isn't in the interest of shareholders, fundamentally, of which, clearly the manager are significant shareholders. We want to do what's best for the long-term nature of shareholders. And that isn't just taking short-term profit, just to say to the market, here's another example of a business that we've exited at a premium. We want to be in it for the long term. We want investors to remain patient. At the same time, when the opportunity presents itself and it's the right opportunity, we will absolutely look to take it. An exit is never off the table. We will always look at it without emotion and objectively and say, is this the right moment? Does this represent a good return for shareholders? And if it does, we will absolutely do that. Hopefully, shareholders will be confident and comfortable that over the next couple of years, the right opportunities will present themselves and we will deliver that outcome. But it takes time. And again, in terms of where we are, it's really important to remind investors that venture is a long-term journey, and of course, being priced day to day can be incredibly frustrating for us and shareholders alike. Ultimately, though, when you look at this data, which is one of the most significant investors in venture funds globally in Adams Street, at least 40% of their venture portfolio is held for 7.5 years. Doesn't mean that exits don't come sooner, but fundamentally, sometimes it can take a little bit longer. And when we look at the profile of our portfolio, it's not identical to this, but it's not too far off. So important to remind and articulate to investors that to deliver those outcomes does sometimes take time, and it takes a little bit longer than you might want. But we hope and believe that investors stay patient and stay with us for the long term, then those rewards will be reflected. I won't dwell on this. I talked about this a little bit of where we focus and why we think we're differentiated. As I kind of rattled through the last few slides, and just a reminder, I'm not going through all 48, but I just want to give a sense of where we are in the market, what we're seeing. We are kind of back to the normalized mean when we strip out the kind of the bubble of 21 and the first half of 22, where we're seeing stability in the market, which is important. We want to know the direction of travel, and the direction of travel this year, it's quite similar to what we've seen in the previous 2 years as well. But we mustn't forget that the market opportunity remains enormous. This is a sector that is growing 4 to 5 times the pace of the broader financial services sector. So we, as a sector, are going to continue to eat into the market share, but we're still early in the journey. Yes, there are hundreds of very valuable businesses being built, but there is a long way still to go. And even in some of those subsectors within financial services, where we've seen very significant market opportunities built in payments, in lending, and insurance, tiny penetration. There is a long way to go. There is a lot of opportunity to be tapped into. We believe we're incredibly well positioned. We think the next 5 years is going to be more exciting than the previous 5. And as you can see with this chart, there is a huge prize to go for. And our job is to try and capitalize on that and give you access to some of those exciting opportunities. And of course, we're seeing some huge businesses that have been built, and for good reasons, because fintechs are really winning. Where we see the incumbents can't build a better experience. We see the likes of Stripe and Adyen, some of our portfolio companies really kind of building momentum, and of course, where it's just in the too hard basket as well. We've seen those kind of neobanks both on the consumer and on the SME side and on the lending side, the likes of Revolut, Zopa, Tide, Monzo, Iwaka, really building big businesses. These have often been put in those too hard basket. We don't love dealing with micro, small businesses. We can't make money out of them. That's because the big banks have huge legacy infrastructure that makes it very hard for them to service these customers effectively. What a great opportunity for businesses such as Tide and Zopa in order to continue to capitalize on a significant market opportunity. And of course, where the incumbents, can't take the risk or feel that it's an area where they can't be the leader. At best, they might be a follower. And we've seen some huge businesses been built over the last 10 years. I think there'll be a lot more to come, in particular in the digital asset space as well. But our job isn't to pit the incumbents against the fintechs. It's, on the one hand, to back businesses that can tackle the inefficiencies and scale and legacy challenges head on. And we've had many businesses and many successes where we've seen the incumbents come in and acquire some of our portfolio companies as well. At the same time, we are working with portfolio companies that are helping solve some of the huge problems that the incumbents have with digital transformation. There's no question that they recognize that collaboration and partnership is the way forward. And we see more and more incumbents investing, partnering, and in some cases acquiring. And we think we will continue to see a very active M&A market over the coming years. And that's an important exit route for a lot of our portfolio, but far from being the sole one as well. You can see that yes, the exit market is starting to pick up both in the US and in Europe as well. We think that will continue to play out over the next couple of years. We see a lot of dry powder on banks and insurers' balance sheets, as well as private equity. And as much as the IPO market is really important, the vast majority of exits do happen through M&A, north of 90%. And so you can't ignore that. And the likely exit for our portfolio companies will be through M&A, albeit we recognize that some of them are incredibly well suited for IPO as well. So before I wrap up, I just want to touch briefly on AI. I think it's very hard to give a presentation without talking about the impact of AI on fintech. What we don't do is get swept up in the hype and the bubble, and there are a lot of inflated valuations, but that shouldn't detract from the huge shift that we're seeing in the market, the huge opportunity ahead, both within our portfolio, both in terms of new investment opportunities, and both in terms of, for us as a manager, how can we effectively use AI to not just maintain our position, but to try and get ahead, and in some cases stay ahead of the competition as well. And so, it is a sector that has a lot of noise, has a lot of bubble, has a lot of capital, but the hype is real in many respects. We are going through a transformative journey, and it is going to continue to deliver an extraordinary impact in every industry over the next 5 years. The question we're asking ourselves is, how do we get exposure? The reality is that, yes, we've seen significant funding, and a lot of almost generalist funds have shifted away from fintech and said, right, we're all about AI. Being a specialist allows us to continue to stick to our knitting, but it doesn't mean that AI isn't underpinning huge amounts of opportunity across the board in financial services. And you'll see that in terms of our portfolio companies as well. This is not new. That our portfolio companies have been building with AI in many cases since day one, and in some cases are are AI-driven propositions. So for us, it's not about suddenly saying, what are you doing about AI? It's what more are you doing? If everything was about Gen AI, what are you doing with agentic AI? How are you working with that? I would say a lot of our businesses, whether it's through credit underwriting or insurance underwriting or fraud detection, or in our business in Switzerland in driving trading decisions for FX gold and soon to be crypto as well. So I think it's fair to say that when you think about the Augmentum portfolio companies, the vast majority of our businesses are building with AI, are working with the next generation of technology, have very capable and talented teams that, in our view, will be ahead of the incumbents. And it shouldn't come as any surprise. Some of the most talented engineers want to work in the fast-growing, dynamic businesses, don't necessarily want to go and work in a traditional bank. They want to work with a business that's growing quickly, that is working with the next generation tech, where they can have a real tangible and deliverable impact. And some of the initiatives that we're seeing, not just that have already been deployed, but what we think will be deployed over the next 12 to 18 months within our portfolio is incredibly exciting. And I think that will make them more efficient. I think that will allow them to grow quicker, and it will make them ultimately more profitable as well. And the pipeline is full, as it should come as no surprise with AI-driven fintechs as well. We take a healthy dose of skepticism in everything that we see, while recognizing the huge shift that is coming. So for us, in all of our investment team meetings, in our investment committees, we're asking the question, what is the defensibility? This might be compelling now, but what is the impact going to be in 12, 24 months' time? Does this proposition have true defensibility? Is it real? Is the market ready for this? And these are the questions that we're asking. But you should be keeping an eye as and when we deploy fresh capital into new opportunities. We believe that AI will play a big part in a number of our new companies going forward. And of course, what are we doing as a team? You can't just sit there and look at your portfolio or look externally. You have to look at how can we become more efficient? How can we kind of stay ahead of the competition? How, with a small team, can we compete with some of the bigger funds out there in order to make sure we're getting access to some of the most compelling opportunities? And here, really, a snapshot of the tools that we're using internally to allow us to really just make sure that we're sifting through the thousands of companies that we're tracking, monitoring, engaging with, thousands of people that we're tracking and monitoring. So if somebody leaves a high quality fintech to build something else, we want to make sure that's flagged on our system. We reach out to them and we start to kind of build that relationship and see if what they're building really fits with our thesis as well, and where we can build that relationship early, often 1 or 2 years before we have any intention of investing, where they get to a point in which it might be appropriate for us to have a more meaningful conversation. So this is something that's continued work in process. The market is moving quickly, but it's something that we're focusing on. And I would say everyone in the team day to day is working with AI, and it is really shifting in how they manage their day and how they become more effective investors. And that ultimately allows us, really to make sure that we're seeing as much as we possibly can in the market. And when we do see something that we have some conviction on, we can really drive through to an answer as quickly as possible, which often is in a competitive market as well. But you can see it's a tiny conversion rate from at the top of the funnel all the way through to ultimately investing. So we are looking, as I said at the beginning, for that needle in a haystack, but we want to make sure that we've got real breadth and coverage of the market. And I think that more effectively using technology is a really effective way for us to be able to do that. Ultimately, though, this is a people-based business. We need to use our judgment. We need to use the benefit of our collective 100 years of experience of building technology businesses, investing in them. There's a lot of pattern recognition. And I think what helps us differentiate in the market is having been around for a long time, seen the good and the bad, learned a lot from the ones that didn't go quite so well, and help those businesses that we still think have potential but haven't quite executed as well as they might have, helping them get on the right track as well. So I'm going to pause there, make sure that we've got plenty of time for questions, and I'm just going to move away from full screen and get to the Q&A. So I'm just going to make sure that I am on the right page there. Okay, I'm just looking for the scroll, so excuse me while I get to the scroll bar and go to the very top. Here we go. Okay, so I'm going to try and rattle through these. First question, what are you doing to boost returns and close the NAV discount, and why should investors stay invested given limited exits recently? Now, that was a pre-submitted question. I hope that the last kind of 40 minutes presentation has given investors comfort and confidence that, one, exiting businesses needs to be, in our view, at the right time, and we shouldn't be prioritizing exits purely to give the market comfort that the underlying NAV is correct. We want to make sure that we're exiting at the right time, but at the same time, our view is that if you look at the profile of the portfolio, the evolving maturity, you will see those exits come at the right time. Ultimately, we would just say, look at the track record, look at what we've been doing, but also recognizing this isn't about delivering, exits on a, 6-monthly basis. This is not a sector that can formulaically deliver those exits, but we do feel and we do hope that when you look at the portfolio and you see some of the growth in the underlying portfolio, that should give comfort. And you look at those peers and you look at how we are valued today with the discount relative to those peers, that there is a lot of value to come. Question, what was the attraction of investing into Retail Book, given the dramatic failure of Primary Bid, which has closed its London operations after losing tens of millions every year, and why, given it's the same management team, do you think it will be different this time round? Also, given the competitive landscape, why do you feel Retail Book will succeed more than platforms like Wrap or Book Build? Look, great question. I can point to hundreds of examples of businesses that have launched, raised huge amounts of money, and have fundamentally failed. I can go back to the beginning of when we built Betfair a long time ago, 20 years ago, 25 years ago. There were 50 exchanges, I would say, that launched over the period that we did. Most of them failed. In fact, almost all of them failed. So just because a business raises a lot of money and fails, it doesn't mean that the proposition is a bad idea. It's a failure of execution. It's also can be timing. And I think in Retail Book side, one, we have been following Retail Book for quite some time. The whole management team didn't come over from Primary Bid. Some of the management team came over who we felt had seen the story, the good and the bad, had learned what worked, what hadn't worked, but the original Retail Book team had no connection with Primary Bid. And we felt, if I'm honest, that Primary Bid raised way too much money at way too high a price. And, for us, we wanted to build a meaningful stake in a business. We invested 3 million. This is not a business that should be raising 50, 100, 150 million. We feel that Retail Book are incredibly well positioned to become the industry utility. They have, integrated with the key retail platforms. And fundamentally, we think there will be one winner and one big winner, and we think they're really well positioned. But this is not a business that we believe requires tens of millions of pounds, or let alone hundreds of millions of pounds. So I think there's been a lot of learnings from what happened at Primary Bid. I think we've got the benefit of a team that has some real hands-on visibility of that. And we're really confident that they can take the lessons, the good and the bad, and work with those original Retail Book members and build a really valuable business. So we're excited about that. And as I said, I think they are really well positioned. What will the board and managers be doing to address the discount? Share buybacks would not appear to be an option as portfolio companies need financing. So important to say that the board is independent. We're not on the board, and the question for buybacks is a matter for the board, not for the manager. It will come as no surprise that there have been in the last 2 years buybacks. They haven't been particularly effective in closing the discount, and we've seen a lot of analysis across the investment trust universe. It doesn't mean that they're off the table. In fact, as part of the AGM, the board will ask for permission to be able to buy back shares as well. But at the same time, we need to make sure that the balance sheet's strong within the business so we can support our portfolio company. So from our point of view, we want to make sure that we have a strong enough balance sheet. There is, I'm sure, going to be a time a moment where buybacks are appropriate, and that's for the board to decide. But you will have seen that over the years we bought up to 6% back of buybacks, so it doesn't mean that we're averse to it. Some holdings like Money's, Whiskey Invest Direct, Habitat have been in the portfolio for many years. Why are they held so long? Are they profitable? Do they need further financing? And then there's a cut-off bottom. So, ultimately, you're always going to have assets in the portfolio that don't work, or they could be profitable, but they're not going to be venture outcomes. And if they're not sucking up capital, then you just hold them and wait. And ultimately, I think in these examples, Money's we've exited, Whiskey Invest Direct and Habitat are both businesses that don't require any cash, haven't been venture outcomes. To be fair, Whiskey was a spin out of Bullion Pool, so it didn't actually cost us anything. We just got a kind of implied shareholding in that business. Habitat hasn't, has been on a challenging journey, now trading well. But we'd written that down significantly many years ago, and we hold that. So there's always going to be assets in the tail that, as long as they're not sucking up capital, you will just wait. And if the right opportunity presents itself, you absolutely will take that exit. But I think that's what you should expect in a portfolio. We also have another number of companies below the top 9, the 80% of NAV, that are incredibly exciting, growing really well, but need time to mature, to develop, to break through. And that's the nature of having that portfolio. So rest assured that we are taking a pretty prudent and in some cases kind of emotionless view of assets that have been in there for a while. And if they need more capital and we don't have conviction, we'll not follow our money. It might mean that we get wiped out, or it might mean that the company kind of winds down or takes money from elsewhere. But ultimately, that's the nature of what we're trying to do. We are trying to find your outlier returns. But at times, there will be a case to say, do you know what? This is a good business. It's worth putting a little bit more money in to protect our initial assets. We're not going to, our initial investments, I should say, we're not going to put a huge amount of money in. But fundamentally, if we put 5 million in it, we think by putting 500,000 in it and restructuring the cap table, we can kind of have a good shot of making our money back and a little bit more on top of that. And we're not afraid to roll up our sleeves. And we've done that really well in the past with a couple of businesses where I would say other investors have just walked away. And we've said, you know what, this is a business that just needs a bit of kind of care and attention. And, not only we made our money back, but we've made some money on top. It hasn't been the venture return, but we're a steward of your money and our own money as well. And we want to make sure that where it makes sense to preserve it and we have a shot to put a little bit more in to protect it, we'll absolutely do that. Declaration, I own 40,000, which for me is a high weighting. There is something on bulletin boards, criticism of the management lately. I wondered what my view is. A criticism that your new proposed investment advisory structure is more beneficial to you than us regular shareholders. You hide failing company write-downs until you've got some positive uplift to balance books, and the company is struggling financially with few realizations. Cash is becoming a problem. I've held for a long while and always believed in your cautious professional approach. What would you say? Wow. Okay. So I really would like to think that we've countered some of that. There's no hiding failing companies. The valuations are the valuations, and you see that with Grover. We're not kind of sitting there looking to balance the book. You have an independent auditor and BDO. You have a valuations committee independent from the manager. So I'd strongly counter that as well. For us, I've talked about realizations. Cash isn't a problem. We still kind of have a good amount of cash on the balance sheet, but we're very clear, and we look 12 months ahead as to what we think might be coming in terms of realization. And as such, what is the cash requirement of the portfolio? How much we'll be investing in new companies and balancing that out. And that will ebb and flow over time. We have no leverage in the business. And, you'll see a lot of funds that that do have leverage. We don't have that. Of course, that's an option. We felt it hasn't been appropriate to date. And for us, I think we've always kind of managed that really carefully. So I kind of really feel that we have good visibility and we're comfortable with where we are. In terms of the manager, for those of you who aren't aware, the externalization of the manager, from our point of view, there's nothing controversial there. I think it's absolutely in the interest of shareholders. It's simply when we listed the structure, we had an external manager, and that was internalized. With the benefit of hindsight, that was a wrong call. The reason that we want to externalize the manager is for a number of reasons. I think, one thing from our point of view is we want to be able to kind of, run other pots of capital in the absence of being able to raise more capital in the public markets. The point on cash there is a fair point. In a situation where we see a great opportunity in one of the portfolio, and it doesn't make sense for the PLC at that point, we'd love to be able to kind of work with co-investors in order to be able to kind of allow them to invest in some of the portfolio to ensure that they've got the runway. We also see a hugely complementary strategy investing much earlier than we do. We recognize it doesn't make sense in PLC to investing at pre-seed and seed typically. The risk is much higher. The longevity of the hold is much longer, but that's an incredible feeder for the PLC structure as well. We're seeing these businesses because we're building relationships. So the opportunity for us to raise a seed fund outside of that, to have a separate team where those fees from that fund would manage that team as well, I think would be fantastically additive and allow the PLC to have real eyes on what are those next generations of companies coming through. So our ambition is to be the leading fintech investor in Europe. The PLC structure is our core focus. It's always been doing, but to be able to have that flexibility and also to be able to share some of that cost, I think is in the interest of our PLC shareholders. And as I've said probably more than once, I'm a big shareholder personally, and so I'm absolutely aligned that I want to do what's best for shareholders. I feel a huge sense of responsibility and ownership for this. We work extraordinarily hard. Ultimately, what we need to do a better job of is driving that share price up. But as I said, I think hopefully sessions such as this address some of those questions, in some cases, some of those misperceptions, and really kind of give investors comfort that we're absolutely kind of pushing in the right direction and making sure that we're in a position to kind of really drive forward the share price. Another question on the internally managed to externally. Hopefully, I've answered that. This question on the discounts of buybacks, which again hopefully has been answered. What email address should proposals for how stock buybacks might be improved be sent to? I think that would be always keen to hear from shareholders. I get a lot of correspondence from not just institutional but retail shareholders as well, which is great. I mean, not always good. We do get some good encouraging emails, but we also get some criticisms as well. And I think it's great to hit them head on as well, and some of them kind of very valid. So just email me, tim@augmentum.vc, and I'll forward them to the board because they're in charge. I'll forward it to our chair, William Reeve, as well. So yeah, do feel free to give feedback, good and bad. Can you comment on Augmentum's own capital position in the context of the ability to raise further capital? Well, hopefully I've done that, where, of course, when you're trading at a 40-45% discount to NAV, you can't issue new shares at that discount. So, always thinking, of course, within the PLC, it's looking at what are the realizations coming down the pipe. As I said, I think there's some pretty established and scaled businesses in the portfolio. One stat I would love to leave you with is there are 37,000 fintechs, or about 37,000 fintechs globally. 100 globally are generating around $500 million in annual revenues. By the end of this year, Augmentum will have 3 of them. So that just gives you a sense of, we are picking winners. And these are all businesses that we back super early. So, again, those types of businesses, we hope in the next kind of year or two will, really present interesting opportunities for us for potential realizations as well. We can't put a timeline on it because you can't control these things and you don't want to necessarily signal. But as I said, hopefully that gives you a sense and a really good stat of how we're providing that really kind of specialized exposure to you. When you exit companies, are there plans to return that excess capital to shareholders? Yeah, I mean, I think it's an interesting question. I think we'll always look at that. And, there is a policy that, we'll look to return a good chunk of that. I think you need to look at the cash position. If we had an outlier exit 100, 150 million, which I'd love to be able to kind of have. Of course, you'd sit there and say, what can we effectively deploy over the next 12 months? And if you don't feel that you can deploy all of that capital, what is the most tax efficient way of delivering that benefit back to shareholders as well? So absolutely, I think that's a really valid question and one in which we will, as and when the opportunity presents itself, look very closely at that. Given the high share price, is Augmentum itself potentially subject to takeover bids to release value? Have you received recent offers, and what is your general? Well, look, we obviously can't talk about that. I'm the manager, not the board. I think just generally, just talking about managing the discount. Hopefully, the last kind of hour has given you a good sense of we need to be on the front foot. In terms of getting out there and telling the story to a wider audience, and hopefully doing whatever we can to be able to kind of close that discount. Surely buying back shares at 38% discount will give the fund a very high return on investment. Yeah, I mean, look, I think discount control. Of course, buying shares is accretive. We totally get it, but you've got to make sure that you've got strength in your balance sheet. Our job as a manager is to invest in great companies and to make sure we've got enough capital to be able to support our growth businesses and defend our positions. So I absolutely buy into the philosophy that buybacks make sense when the balance sheet is at the right level and the moment in time is such that it makes sense. And of course, discount control is about closing the discount, and the data will tell you currently that share buybacks aren't solving the problem of closing the discount. Of course, it absolutely is making, it delivers the return and it is accretive, but you're also shrinking the size of the trust. And one of the challenges that we get, I guess, leveled at us is that scale is important, and you need to be bigger. And one of the reasons that the discount is there is because, scale is one issue. So on the one hand, you might be solving one problem, but you might be creating a bigger problem on the other side. So I don't think there is a right answer. And as I said, I think that's very much one for the PLC board rather than the manager. But for me, I've looked really closely at the data, at the analytics across the investment trust universe. And again, if people do have kind of creative, fresh ideas on what we might be doing differently or better, on discount control, then do let us know, and I'll pass that on to our board as well. Last question, perfect time, just 11. Some investment trusts trading at a discount offer shareholders a redemption facility close to net asset value per share. Are you looking to potentially do the same? Again, not one for the manager, one for the board, but I will definitely kind of pass all these questions on to the PLC board as well, because I think there have been a lot of really good ones. And hopefully over the last hour, I've given you a snapshot of what we've seen over the past year within the portfolio and within the market more generally. 2, kind of hit some of those frustrations, criticisms head on. 3, really given you some renewed optimism and excitement as to what's ahead. 4, also talked about why you might not have seen the number of exits that you would necessarily like, but also giving you real comfort and confidence that the direction of travel of the portfolio we think is really exciting. It's made huge amounts of progress. The discount is unwarranted. There's a lot. We hope that will be reflected in time in a re-rating. A lot of that is outside of our control, but it doesn't mean that we're sitting and waiting for the market conditions to improve. We feel that the momentum is coming. We're seeing a lot of positive signs of that. Unfortunately, a lot of it over the pond, but we think that will come across the Atlantic in the coming months and beyond. So thank you again for a lot of the great questions and for taking the time to listen to this call. As always, we'll continue to closely follow the retail investor forums, just to kind of hear what's happening out there, what people are thinking, and try and address some of those questions in our communications, in forums such as this, in our presentations as well. And as I've always said, please do feel free to contact us directly, and do download the presentation as well from the website as well if you want to dig into it in more detail. Thank you very much and have a good morning.
That's great. Well, Tim, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. On behalf of the management team of Augmentum FinTech PLC, we'd like to thank you for attending today's presentation, and good morning to you all.